Good morning. Good morning. Looks like people are joining in. Thank you, Tejinder Singh, for joining in. Rajesh, Moez. I think we'll give a couple of minutes for people to join in. Um, can people can try and give a thumbs up to tell me whether they can see the screen, what I'm sharing, just to make sure we get the housekeeping right. Thanks, boys. I can see the thumbs up. Rajesh, thanks for typing it in while driving. Be careful. And I admire the commitment for people joining in while driving. It's good. All right. I think Pran is joining in. I've just let Pran in. Can you guys hear me well as well? Is my audio coming through fine? Thumbs up, love heart, whatever makes sense. Please send that through. Great, great. Thank you, Moise. I think let's give us 1 or 2 minutes more and we can kickstart the session. So most of you are from Melbourne or people are joining from a different state. It'd be good to know. Thank you, Tejinder. You're in Melbourne too, right? Of course. So I'm based in Melbourne, as most of you might know already. But of course, people are joining from interstate, sometimes from a different country. So things have become so good these days. We can reach out and talk to people and communicate and service them throughout the world since COVID. So yeah, it's great. And you all can also see my main screen where I've got how to master your money free webinar. Yeah, good. All right. We've got a few more people joining us. Jay has just joined in. Great. Thank you. Thank you. Thank you, Jay, coming through. 1 more minute guidance, and we should kick in. I think, yeah, just to respect everyone's time, we should just start. I'm super excited to be presenting to all of you today. Yeah, hopefully this session will add a lot of value and you'll get a lot of insights and take action from here. That's my whole purpose. Okay, we're nearly there. Those who just joined, Jay, can you hear me well and see? Yeah. Thumbs up would be good. Okay. I think we should kickstart, guys. What do you say? Yep. All right. So thank you so much. I'm Karthik Ganapati. So I'm a registered financial advisor. I'm your host today. And today I'm going to take you through this webinar. And I want this session to be quite informative. And I also want this to be educational. So take this opportunity to absorb as much as you can. And towards the end of the session, I will open up for questioning. So you would have an opportunity to ask questions, and I'll try and answer them to as best as I can. So you'll have opportunity. All of you will have opportunity to ask questions. So in between, if you have anything that you can't wait to ask me, please put that in chat. I'll see if I can answer them while I'm presenting. But yes, you'll all have an opportunity at the end of the session to ask a lot of questions. So reserve your question. I'm sure that there'll be more questions coming along as you would uncover what we're discussing today. So let's kick in, guys. Okay. So let's be clear on the goal. I think I want to just to reconfirm what we're here for. So the topic of the webinar was to control your finances and build wealth. That's the main topic. So sticking to that, I'm sure you all want to master your money. That's why you're here. You've taken the time. You're serious about taking charge of your financial future. So that's why you're here for. I'm sure there's no other reason why you take some time on a beautiful day like this, if you're in Melbourne on a Saturday, to be in this webinar. Smart tax strategies is also top of your mind because guess what? Nobody wants to pay tax if it's not required, right? What I say is you don't want to be tipping the ATO. ATO is already quite rich. So if you can save tax through smart strategies, we should all be doing that. And I think that's definitely one of our goals today. And talk about it and understand that. We want to make sure that we empower our future generation because if you have children, we want to make sure that children's wealth is protected. We pass on the wealth in the most smooth way and tax effective way. And this is super important. Learn from wealthy people who have done well in life, done accumulated wealth. They've done something right. That's why they've done well when it comes to money. So let's understand what are the structures they use to build that wealth. And there's a lot we can learn from rich people. And in my journey as a financial advisor, I've come across a lot of people, and there's a lot we can learn from it. And I'm going to share all those things today. So super excited. I'm admitting people. Ling, thank you, Ling, for joining us today as people are coming in. So, of course, financial freedom is super important. What is it? Everyone's different, right? Financial freedom is a very subjective term. So it has to basically meet your lifestyle, whatever lifestyle that you want to, whether you want to work part-time, whether you want to retire early, all that is financial freedom to you. Because when you have the freedom to make those choices, then, you're living your life. So money plays a big role in that because when you have enough wealth, you can make those choices. So how is the goal? Hope you all understand why we are here today. And give me a thumbs up if this makes sense. Let's go into the challenges though. Like goal is fine. We understand we need to do things. We understand that we need to build wealth. We need to be tax savvy and all that. But then there are challenges, right? And these are some of the common challenges I always come across when I'm talking to people. High income tax. Australia is one of the highest tax rates in this world. Like we live in a very lucky country because we are well taken care of. We have good standard of living here. We have a school system which is free. We have a public health system which is free. All that requires a lot of tax money to be able to continuously deliver as the population is growing. So tax system is quite high, but there's no reason why we can't be smarter on that. And that's definitely a challenge. As your income goes up, you tend to pay more tax. And that's just the nature of things. If you make more money, the tax is more. We are time poor because we live a busy life. We work, we have family commitments. Definitely that's a challenge. And that can come in way in terms of your focus time to build wealth. There's too much information now because every second person on the internet is giving you money advice, whether that's an 18-year-old or a 50-year-old or a 60-year-old. Nothing wrong. I mean, people have good intentions, but sometimes that's misguiding. And I think, it could be very dangerous. I've seen people who've gone on that path and, made mistakes. Then some other challenges is we have mortgages. We've bought our home. We want to probably buy our investment property or buy the second, third, whatever that is, but we have mortgage. But we also need to think about whether that's, should we pay off the mortgage or should we invest? This is a common challenge when I'm talking to people. And we will try and uncover those things today. Investing for children. If you have children, then we want to make sure that we provide for our children, whether that is school fees or deposit for the first home, whatever that is, or gift to them when they're getting married. We all probably have that thought in our mind, but that's a challenge. How do you go about it in a smart way, tax effective way? And then understanding income and expenses is very, very important. And I think where people get it wrong is people, when they go start investing and buying things and property shares, whatever that is, and if they work or do it from the point of view where they don't understand the income and expenses, that's where things can go wrong. I've seen people who've bought properties or invested in things now because of the interest rate going up. The challenge is that they're not able to keep up with the expenses, and that is forcing them to sell or cut down on lifestyle, holidays, all those things. And that's because we've not planned that well. We've not understood our current income and expenses, and we've not factored in all those changes. And these are some of the challenges, very common. So yeah, so these are some of the challenges which is coming our way, and we'll see what we can do about it, right? So what are the solutions? Now, how do we solve this? Like traditionally, if you think about me, if I was not a financial advisor or if I was just a common man, what would I do? I normally would go talk to my friends, right? I'll go talk to my friends, I'll talk to my family, and they have the right intention. And often they give you bad advice because they don't know and they only know what they know, right? So if their knowledge is limited and if their experience in life is limited, they are going to give you the advice based on what they know. And the intention is right. But the advice may be completely wrong. I've seen that. So this is what we do. We go to friends and family, and then sometimes we take our own efforts to build wealth, self-interest. Like we might just invest in shares, we might go buy properties, we might do some side business, but we'll do that on our own without getting any professional advice or help. And then one common thing in Australia is to come out of this wealth problem is to build property or buy property, because I think that's probably the most tangible thing for us to see. It's look around us, we think property is there, we should buy property, and this notion of property doubling in every 10 years is quite widely talking about it. But then what we need to understand is there are a lot of vested interest when it comes to property. There are developers, there are buyers agents, there are real estate agents. Who are they working for? Are they working for you? Are they working for the business, or are they for themselves? That's a question you need to ask. So when we get caught up in that, it can be really costly. And I've seen people buying townhouses, apartments, lost money, buying house and land package, lost money. All those things can be really dangerous when you're not working with someone who's got your best interest at heart. They've got nothing to do with the property they're selling. It's all about pure advice. And that's basically is important to understand. But don't worry, this is how people normally go about doing. But we're going to talk about what is possible for you, right? That's what we're here for. So the new way to do things and the better way to do things is to have a clear strategy. So understand how professionally you can manage your finances. So you want to start with your financial goals. You don't want to go down the path of investing or wealth building without understanding what is the final outcome. What are you trying to do here? Are you trying to retire early? Do you want to cut down on your work from full time to part time? What is the objective? Without understanding that objective, if you start going down this path of wealth building, then it can lead to things where you're not really happy. You might have done something well, but you're not happy. You're not spending enough time with your family. Your finances are tight, and that's because you're not thought through what is the real financial goal. What does it really mean to you? What do you want to achieve from life? So have a clear financial goal is very important. Then you want to start thinking about what are the ways to minimize tax, because as you build wealth, you're building income, you're building equity. So that comes with tax, right? So the ATO is not going to let you make money and not take the pie. So you want to make sure, how do you play with the ATO in a smart way, legal way, and minimize tax? Simple. We're not here to talk about tax avoidance. We're here to talk about how to legally be smart around tax. And that's what we need to do. And that's the first thing to think about. And then you have an investment strategy. You don't start about invest and then think about tax. You first think about the tax of consequence of that investment, which you're about to do, and then you invest. So I have a story of this client that I've helped recently. He's 67 years of age, and he's built a $5 million property portfolio. Unfortunately, now as he sells, he'll be liable for capital gains tax. Now, had he invested that under a super, for example, because of his age, as he sells, there's no capital gains tax. So these are small things, but he obviously didn't realize this because he only looked from the investment point of view, not from the tax point of view. So very important to understand tax and then go about doing investment strategy. And also, you want to make sure your assets are protected. Like, there's no point building your wealth and then it's not protected, like from somebody suing you, or sometimes there's a marriage breakdown. Sometimes it's like you're in business and you want to protect your assets. So asset protection is very important. Or sometimes things like crazy things can happen in life. People can pass away or lose their job. But how do you make sure you still maintain that property? You're able to afford that repayments, things like that. And finally, estate plan. One day, we all know that wealth will pass from us to the next generation. It's going to happen, inevitable. So you have to start thinking about it now, because there's no point thinking about it late, because then it's too late. You can't change ownership. You can't just transfer the assets from your name to someone else. All of that can incur a lot of tax, stamp duty, things like that. It's very expensive. So that's why we need to think about all these 5 steps first before we start going down the path of wealth building. And that is a smarter and better way. And that's why we're here today for. So hope that made sense. So clear strategy is very important. Now, moving on. As we were talking about, understanding tax is important. And before we go down the path of investing, let's just talk about tax, right? So I've made some example here, and hope it makes sense. Here we're talking about an investment. Let's say you made an investment and it's giving you a 10% gross return, whether that's rental income, income from business, or income from business, probably not the case here, income from shares, whatever that is. If you're getting a 10% gross income, you've got to understand what is the net effect to you. Because if you make 10%, you don't get to keep that 10%. You have to give some to the ATO, to the taxman, right? So if you're an individual, most of you probably know that the tax rate can vary from 0% to 47%. Depends upon where what your income slab is. So I want to keep things simple here. Essentially, if you're making 10% and if you're at a 39% marginal tax rate, you will only have 6.1% left after giving away tax. And that is what you make from that 10%. You don't really get to keep the 10%. You only get to keep 6.1 because you've given that money to the tax man. Now, let's say you build your investments under a family trust, which is an option. A lot of people do it. But again, family trust doesn't really reduce your tax. What it does is it allows you to have more flexibility when it comes to dividing the income between the members in the family trust. So you could have your kids, your parents, whoever that is, in a family trust. Generally, they are the people. And then if you are able to divide the income to them, then you are able to do that. But it doesn't mean that you can avoid tax. But essentially, the tax rate still is what the individual is who's getting that income, final income, for example. So it can still be around 6.1%, because if they all are on a good income, they're making good money. And but it can be even 0% if they are 18 and above and don't make money. It's possible, but it depends on the situation. Now, talking about investment bond, which is one of the things a lot of wealthy people use and smart and savvy people use, is this is a structure where the tax rate is much lower than your marginal tax rate. It does not have a marginal tax rate. It has a maximum tax rate of 30%, and usually it's between 25 and 30%. So effectively, the same 10%, if it was invested under an investment bond, which is another tax structure, the net returns are between 7 and 7.5%. So you can see that's already better than individual name. Now, let's say the same investments, you held it under a superannuation, not under your personal name, not under a family trust, not under an investment bond, under your super, because your super allows you to invest your money. You can take control of your super. The tax rate in super is only 15%, which means you only pay 1.5% to the ATO, and you get to keep 8.5% to yourself. And see the difference? That's a huge difference, right? And if you look at it from numbers point of view, if it's a $10,000 income, you get to keep 8,500. But here, as an individual, you only get to keep $6,100. Does that make sense? So it's actually gets really, really good if you understand these things. Now, the last point I want to make here is superannuation is only taxable until you retire. Sorry, until you work. once you stop working and you retire, which is possible after 60, superannuation system is quite generous in Australia. It's one of the most generous systems. There is no tax. It's a 0% tax up to 1.9 million. Individual people can have up to 1.9 million. If you're a couple, that's $3.8 million of assets, shares, property, whatnot, could be anything. And it's 0% tax, which means you get to keep the whole 10% to yourself and not parting anything with the ATO. So that is the power of understanding the tax structure and understanding the tax system in Australia. So I hope that made some sense, and you probably took away how it's not about the 10% return. It's actually about the net effect. What do you get to keep is what matters, not the headline number. So don't go with the headline number. Always think what is going to be my, piece of the pie, if I can say so. Okay, so that's the tax system when it comes to gross income. Let's look at capital gains, because when you're building wealth, there are two components, right? One is you're getting income, and also you're building equity. You're growing your asset, which is not income, but it's the value of the asset pool is growing. If it's property, your property value is growing. So you don't really get to pay tax when it's growing. You only get to pay tax on it when you actually sell it. If it's shares, if it's a capital growth, let's say you bought a share for $100, tomorrow is $200. You don't pay tax just because it went up. You only pay tax if you sell it at $200 because you made a profit of $100. Yeah, hopefully it's making sense as I'm talking. So when you make a profit, which we all want to make, because what's the point of investing where we're not making a profit, right? So let's say we've made a profit. If it's property or shares, and if you do it for a long period of time, obviously your pool of, you might start small, but as the wealth grows, it's going to be significant. And we all, I think, here want to build wealth in a significant way. We are not here to just, time pass. We want to do something better. So I've taken an example of $500,000 just to be, keep it general. I hope people, and we can do better, millions of dollars, but then let's just talk about $500,000. $500,000 profit, what we're talking about here is this profit will get distributed to people who own it, right? Whether that's individuals, whether that's the members of the family trust, whether that's through investment bond or superannuation, or a superannuation pension phase or retirement phase, because you can own assets under these names. Now let's have a look at how does this affect. So capital gains tax, you get a discount on the profit, 50% discount if you held that asset for more than 12 months. And I'm assuming that is the case, because I'm not here to talk about investing for 5 months or 6 months. Investing by virtue is over a long period of time, because that's more reliable, less riskier. Over a short period of time, if you're trying to invest, you're actually gambling, not investing. And we're not talking about that here today. So $500,000. Now, even if your tax rate is 30% or 37% plus the Medicare levy, but if you make a profit for that financial year, you're going to be in the 47% tax bracket, because what's going to happen is your regular income is going to be, let's say it's 100,000, and this 500,000 and gets discount of 50, which means taxable, the gain is $250,000 for that year. Your regular 100,000 plus this 250,000, which is taxable, means you have a $350,000 tax bill, or taxable income, I should say. So people will get to the higher tax bracket when they're selling assets for a profit, generally speaking. So if you're an individual, just the tax alone would be around $117,000. So your net profit is only $382,000. And that is the effect of tax, right? So you need to understand the bigger picture. And when taxes are hundreds and thousands of dollars, if you're making a profit for hundreds and thousands of dollars, the tax is also hundreds and thousands of dollars. So family trust, again depends upon whether you have the flexibility to, distribute the profit to members. If not, there's not much difference, because at the end of the day, marginal tax rate kicks in because the member who's receiving the final profit will pay the tax. But if it's investment bonds, this is where wealthy people, smart people understand these things and take action. Is if it's an investment bond, if you held the investment bond for more than 10 years, and if you sell, there's no capital gains tax, which means you get to keep the whole $500,000 profit. And this is what is the difference between doing it in a tax effective way versus doing it in a, just doing it in a personal name. Because tax structure can make a big difference. So the $500,000 profit, if it's done through investment bond and the investment bond was held for 10 years, so there's a caveat, it has to be held for 10 years, a long term, um, because the government don't want you to just, just invest for 1 or 2 years and just take the money. No, they want you to invest for a long period of time. But if you do through this structure, there is an incentive. And the incentive is there's no capital gains tax. So you can get to keep the whole profit. But this is how $500,000 can be tax free, pretty much, right? Now, while you're working, whether you're 30, 40, 50, 20-year old, there is a tax because superannuation has a tax system, but it's not like individual tax system. It's a flat 15% tax for most people whose income is under $250,000. So if you make a profit through superannuation, essentially you only pay 15% tax, that which is about $50,000 inside super. So you get to keep $450,000. But it gets really good when you've reached age 60 and above, because what you're doing today, one day people are going to turn 60. Whatever super balance they have today will grow into something bigger, hopefully much better. At that stage, any profit or any capital gains is 0% tax, because the super system, as I said earlier, gives 1.9 million tax-free asset to members right now. The rules can change in the future. The government is always trying to fiddle with superannuation, but right now it's still one of the most generous, because 1.9 million is still quite generous, tax-free, right, asset. So as a couple, again, $3.8 million is available. So this is very important to understand that capital gains tax is something that we all have to pay. That's only if we don't understand these structures. If you understand these structures and we actually invest according to our goals, financial goals, and have a plan for these structures, then we can manage the capital gains tax in many ways, and we probably can do without paying capital gains tax. And that's why this is very important to understand. I hope this is making sense, guys. I'm happy for you to just ask questions here and there. If it's something that I can answer, I'll actually answer. If not, again, I'll reserve it for towards the end of the session. So hopefully so far it's making sense. How are you guys feeling so far? Can I get some thumbs ups or some emojis coming up, just so that I'm still motivated to give you a good presentation? Any questions so far, guys? Should I continue? I'll take it as a yes. Okay, good. Now, what are the steps to build wealth? I think we talked about our goals. We talked about the challenges. We talked about what are the tax structures. The steps to build wealth is basically there are 4 structures that can really work in our favor, which is owning assets under individual and joint ownership, owning assets through superannuation and SMSF, owning assets under investment bond, and owning assets under family trust. Now, most people start here, number 1, which is just individual, and then gradually they take control of their finances and wealth, and they get into superannuation, SMSF, investment bond, and when things get really good, we start talking about family trust. So these are the 4 ways or steps, I would say, smart wealth building means. And this is how I've helped people in the past to build and scale up their wealth. Okay, I'm going to give you some real client story here, which hopefully will make sense. Basically, I'm going to talk you through 3 scenarios. So some clients that I've helped recently. I think Rajesh has just asked me a question. Can I have, let's see what the question is. Can we have an investment bond inside SMSF or family trust? Yes, investment bond can be held under a family trust. Not under an SMSF, but under a family trust is possible, which is mostly the case, yes. And we'll talk about it as we go. Okay, so let's come to the scenario that I want to take you through. There are 3 clients, all my existing clients, and they're different. I've chosen these 3 different kinds just to give you an idea. So the first client, he's a single person. He's 35-year-old, earning about 110K, has a mortgage, about 347,000, has a super of maybe $74,000, and savings and some shares worth $35,000. Now, we also have a couple that I help. They're in their 30s. One child, good income, $325,000 income, family income, mortgage close to $1 million. And then they have savings and shares worth $80,000. And then also have a couple in the late 40s. They're actually doing quite well. The family income is about $670,000. And their story is that they have a couple of properties, $1 million property. They have a lot of money in offset account, which is about $280,000, and also some shares. And they have a mortgage, which is $1.8 million. But the income is really good because they're in high position. Very good clients, all of them, and they have different, life stages where they are in. So we did some advice for them. So I had a strategy for them, and we've implemented the strategy now. What I'm going to share here is I'm going to show what we've done and what is the effect, what is the net effect to their life based on the strategy and financial advice that I did recently. So this is all about monetary benefit due to advice, just the difference that the advice makes to their life over a period of time. Obviously, the longer we be in the path of wealth building, the bigger the difference is to the bottom line. So the first client, 35-year-old who works for Telstra, IT guy, starting small right now. But by the time he'll turn 60, he'll have more than $2.1 million in net assets. Net assets we are talking about. And he's better off by 1.1 million purely because of the advice. And what did we do? We started him on a $200 per month investment account. And we also made sure that his superannuation was paying less fee and also invested in a way which was going to better perform over a long period of time. So just two things alone is going to make a big difference to his bottom line. So he's going to be better off by close to 1.1 million. Now, this is what it does when you actually take control of your finances and take some actions early on, and things can really look well as time goes by. The second couple, the younger couple in their 30s with one child, what it did for them is I came with a strategy where we will sell their current home because they want to upgrade. They want to buy a home which is $1.3 million. They do have an investment property, but you're holding that investment property. I also help them setting up an investment bond. So we will invest regular money into that, and that'll build up. But remember, investment bond, as I said, if you hold it for 10 years, there's no capital gains tax, right? And while you're investing, the tax rate is quite low because it's only between 25 and 30%, which is much lower than your marginal tax rate. And these both couple have a higher marginal tax rate than 30%. So the net assets for this couple would be, by the time they're 30, 25 plus years, will be about $10.4 million. That's very good, right? And this is adjusted to today's value. So if they were 60 today, this is what they'll have. And they're better off by $3.8 million because of this strategy and overall. And that is, again, fantastic when you actually understand these things and you can see visually. And I hopefully can share some screen. I'll show you some graphs where you can understand how that looks in real life as well. And the last couple, the couple in the late 40s, high up, one of them is in HR, another person is in IT, good salary. Two boys they have, yeah, they're doing well, but obviously they didn't have a structure, plan, strategy in place. So what I did was the initial strategy is that they continue to rent to us. They live in Brighton. They want to hold on to these two properties that they have. So we decided to just them not buying a home right now. They might change their plans, and that's basically, again, a financial plan is what you need to understand is that when you start financial planning, you start with some goals today, and the goals might change next year, the following year, because things changes in our life. Our income might change, our jobs might change, the tax rules might change. Things can change, and and the whole idea of financial planning is to keep up with those changes, right? And that's why it's important to have a long-term view, not short-term transaction view. Coming back to this couple, we are rent vesting right now, and again, I help them with the investment bond because they are on a 47% tax bracket. Investment bond can completely make sense to them, and we are also setting up an SMSF and investing their super through the SMSF. So what it's going to do now is it's going to really help them, be strategic around their financial life. And because of that, they'll have close to $50 million net asset by the time they're 65. But this advice alone is going to make them better off by close to $2.8 million. Now, $2.8 million, that's really good. You might wonder why this couple are better off by 3.8 million, while this couple, the older couple who had more money, is only better off by 2.8 million. Has anyone thought about this? Why someone who is having less money now, less income now, is going to be better off than someone who's earning twice as much? Uh, any thoughts? I'll be interested in knowing if someone can say, what do you think? Why do you think this couple is doing much better than the couple in the late 40s, the younger couple in the 30s? Any thoughts? There's no right or wrong answer. Fantastic, Pran. I'm super proud. Yes, time in the market. That's it. Yes, time is the biggest advantage we all have. We don't realize how much time can help us build wealth. The sooner you start, the better it is. That's why time. Warren Buffett, most people might have heard, the famous investor, billionaire, top one of the top richest person in the world, says compounding is the eighth wonder of the world. So when you have time, what you do is that when you start small, over time, that compounds because you're earning interest over your capital, interest. And the longer time period you have, the more better you can do and more wealth you can generate. And that's exactly is what Pran is saying here is this couple in the 30s, they have more than 25 years before they turn 60. But this couple in the late 40s, they have around 17 or 18 years. So that is the difference here. Now, this couple here, if obviously they had 25 years, I'm sure this 2.8 million would probably look something like 5 million. I know for sure, because that's what compounding does. The you, it's so magical that it's hard to comprehend, and that's why people miss the mark. They think people are generally, it's very hard for them to visualize this over 10, 15, 20 years. We are just looking at what is right in front of us. And as a financial advisor, my role is to bring about these conversations, make people understand the power of compounding, power of planning, and long-term thinking, and how. Because guess what? We all are going to get old one day. We all are going to get to that age one day. So the decisions that we take today is going to really help us down the track. So great, thank you. So I hope that made sense in terms of how advice can really benefit these couple. And maybe I'll share my screen, different screen, and see if I can show you the modeling that I did, and hopefully that will actually even help you visualize how it makes sense. And let me see if I can log in for you guys. Okay. I think I'm just about there, guys. Okay. All right. I think I should be able to share my screen. Let's see if this works. I'm going to share a new screen. So can you guys see a new screen now? Can people give me a thumbs up? Because I'm not sure. I think I'm just kidding. I'm pretty sure you guys are seeing what I'm seeing, but it'll be nice if I can see people. Yeah, awesome. All right. So this couple that I was talking about, see the base plan and buy a home. So remember, I talked about how the strategy was to buy and upgrade the principal place of residence to 1.3 million and start investing in investment bond and some shares. This is the base plan. So this is when, before they saw me, this is how their life would look like. And the buy a home and investing into investment bond and also investing into shares inside the super is this buy home plan. So I'm going to take my cursor, and as I'm moving to the right, you can see how the total assets are changing. Now, by the time they're 45, if they had just been doing what they've been doing, you can see the total assets they would have is up to 3.7 million, right? And out of that, the super is about 1.1 million. And then the rest of it is actually taxable assets because they were building shares inside their personal name. And the non-liquid assets is basically the property. Now you can see at the bottom, which is buy a home, same, they will actually have up to 5.1 million. So see the difference, more than 1.3 million, 1.4 million. And why? Because the superannuation is much higher, the property value has gone up, and their taxable assets are less because you don't want to have a lot of taxable assets. As you grow assets, as we discussed earlier, you pay a lot of tax. So you want to reduce your taxable assets. And that's what this plan is doing for them. And I'm going to take it to 860 because that's what I was talking to you about earlier. At 860, by this time, and if you can remember the previous slide when I showed you, by this time, 61, they will actually have 10,472,000 by and going through our plan. Now, if they were to just do what they were doing, they were still doing fine. They're good because by the time they retire, they'll have about 6.6 million. But because of the advice, because of the strategy, you can see that the net asset is about 10.4 million. And that's why, and you can see the superannuation is really going crazy there. It's about 5.9 million, right? So, and that's going to be tax effective strategy. As remember, superannuation gets taxed only at 15% while you're working, and the capital gains is only 10%. And when you stop working at 60, there's zero tax on income, zero tax on capital gains. An investment bond, after 10 years, there is zero capital gains tax. So all those strategies working in their favor, and that's why they're better off by close to like $3.8 million. And that's in the next 20, 25 years. So this is the power of having strategy, well thought out strategy, and then making a financial decision. So the point here to understand is that there's an opportunity cost. We all probably will be fine without strategy and advice. It's just that we don't know how much better off we can be with the property, with a proper strategy and advice. And that's what financial planning does. I hope this made sense, guys. Give me a thumbs up if it made sense. And yeah, I'll move on to my next slide. So I hope I can just stop sharing here and move on. Any questions so far? Let me know. Happy to answer. But let's see if I can move on to my. There are a lot of questions. Good. Thank you. Thank you. Thank you. It's making sense. Beautiful. Thank you, Tajinder. Thank you, Rajesh. Fran. Yeah, good. Thank you. All right. Let me just go back to my slide. So, okay. Back to my presentation here. So now we understand the value that advice can do and how that can impact your net asset. Let's just move on. Probably time for me to talk to you about, why should you listen to me? Who am I? I think people need to understand who they're talking to, right? So I think most of you might already know who I am, but let's just let me give you a small spill, if you allow me. So I'm a financial advisor, registered financial advisor, which means I come under the regulation of ASIC, and any advice I give is very professional, and we have to follow strict rules and guidelines. So that's basically, so I'm not someone who's just talking to you over the internet. Hopefully that makes sense, right? And I've been in financial advice since 2013, practicing financial advisor. But all my career, I've actually been in finance. Since 2007, I was working at NAB. And then in 2013, I actually became an advisor. And that is also because of my personal story. Like, I've never had any issue with money as such. I grew up in a good middle class family. I had all the wealth. Parents supported me. They sent me here. So I grew up in India. I came here in 2001 as a student, did my studies, got a job at NAB. All that was well. I've never had any problem with money. But one thing that I never learned and never taught was how to manage my money. And it took me a while before I understood that I've wasted so much time and money. And the learnings actually came when I was working in the wealth arm of National Bank, because you are surrounded with smart people and they're doing something different. and you are making the same money, but they're doing better. They have better assets. Their wealth is growing, but I was not growing because I was spending my money. I was not investing. So that led to me, thinking through what I really wanted to do. And being in a bank, I had this opportunity somehow landed upon me. Like I'd never planned to become a financial advisor, but I think it was all part of the bigger play. I was not doing well financially, and then I wanted to learn. And then once I started learning, I knew that there was a pathway to also do this professionally. So I started studying to become a financial advisor. And my background studies is in accounting and business masters, but I took financial planning, and then yeah, I never looked back since then. So 2018, I actually became a certified financial planner, which is there are only less than ah talking about financial advisors, there are hardly any financial advisors left. Actually, there are only 14,000 registered financial advisors. Roughly, that number is arguable, probably less than that because probably a lot of them are not even practicing. They're registered, and out of that, maybe there are only like 3 or 5,000 certified financial planner, which is highest professional designation, very respected in Australia. And then in 2022, I also became an SMSF specialist advisor because I wanted to make sure that I was able to deliver and provide the best possible advice to my clients. Because the clients, as I was helping them out, as I was growing their wealth, there was a time where SMSF was probably the right solution for them. So I had to make sure that I was able to cater to the needs. So I became an SMSF specialist advisor. Again, it's also quite very well sought out designation. And right now in 2024, I oversee more than $150 million of funds. That is clients' money, liquid money we're talking about. We're not talking about properties that I help them manage or give advice, but it's just liquid money, invested money, shares, superannuation, all those things. I hope that gave you some context, guys. Yeah. So I think that's enough about me. Let's move on. Okay. So it's important to understand, like, what is your investment? So as financial planning, you need to understand what is it from your end, what is the investment that you require to get financial advice from me. So there are different layers of financial advice based on the amount of work is required and the situation of the particular person that I'm talking to about. Now, financial advice is generally the various fees across the people or the advisor you talk to based on the experience and how long they've been advising. Somebody like me, the fees could be upwards of anywhere between $3,000 to $5,000. It's quite common, but for the purpose of the webinar and because you've taken the time and coming here, I've actually made it very enticing and good value to all the people here. So there are three layers, as I said. Number one is wealth building. So the people who are just starting out, who whether it's couple or single, doesn't matter. This would cover because you need to start. You need to get the foundation right. You need to make sure your cash flow is good. You need to understand you have a budget and plan. You should spend less than what you earn. All that is cash flow advice. Mortgage advice, making sure you structure your mortgage well. You don't waste money with where there's tax deduction available. Superannuation is one of your biggest asset, tax effective asset, as we've been talking about. We want to make sure that that's taken care of. Investment bond, personal insurance, like, very important when you're young and you're building wealth. You have personal insurance in place because if something goes wrong, all the financial plan that we have in place can crumble if there's no backup plan. And that's what personal insurance does. For this whole advice, usually my fees would be 3,300, but for this webinar, it's only $1,900, and that's great value. Now, people who are a little ahead in their journey, and they want to, because I start with wealth build, and as they grow, as they get better, we start doing other stuff like we talk about family trust. I invest in direct share portfolio because owning shares directly has different tax benefits. We talk about buying investment property and planning for investment property, or even selling current property and doing all those things. And there's also an annual review and estate planning process because when you start your financial planning journey, as I said earlier, it's a process, right? Things doesn't happen overnight. You need to make sure that you have a plan, and then you constantly review the plan. So it's very important that when you are doing well, you review your plans to make sure it makes sense to your financial goals that you set out for yourself. And if there's a change in financial goal, you want to then make sure the financial plan in place is adjusted accordingly. So that's the next level of financial planning. So you start with build wealth, then you go to the next level, which I call it accelerate wealth, because now you're in a, your foundation is set. You're just pressing down the accelerator and you're going fast in wealth building, if I can use that analogy. And then once you're in the free lane where you're actually pretty much smooth, you're going, you really now want to dominate your wealth. That is, you want to really, really take it to the next level. And for that, you want to start thinking things like SMSF, because SMSF can be really, really flexible for people when it comes to wealth building. Retirement planning, because you need to start thinking about what is the exit plan with your assets and investments, because again, one day you probably have to sell it or pass it on to the children. Also, you want to now take more control and understand that things can change a lot in your life. So you want to be able to catch up at least twice a year to make sure your financial plan is in process. So all that is, I call it dominate wealth. So depends on where you are. The fees is 3,300, 4,400, and 5,500. But for the people in the webinar and people who are committed, the fees are going to be much lower. It's 1,900, 2,900, and 3,900, and that's it. So hope that made sense. Any questions, let me know. I'll try and answer them as I go. But again, you'll have enough opportunity towards the end of, and I'm gonna give you a couple of more insights on how flexible the fees can be. Okay, how will this work usually? Because now that you know what is your investment, you need to understand what is involved in this whole process, right? Because that's very important to understand. So it starts with engagement. So we have an engagement meeting, 60 to 90 minutes, where we understand, I talk about what your financial goals are, clarify your doubt, and understand what your needs are. Then I go about doing research in your financial situation. I understand your cash flow, your debt, your assets, your income, everything. I want to know all those things before I can actually start giving you any sort of guidance. So we have a strategy meeting after that. In that strategy meeting, I actually talk to you about what could be, how can we achieve your financial goals? What need to do now? All that strategy is discussed in the strategy meeting. Then I go into advice meeting, which means after strategy meeting, I go away, come back with the final advice to you. And then after the advice is presented, we implement that advice. So it's not about just giving you advice, we also do the work. So my team does the implementation, setting up accounts, following up, all those that work. Then we want to make sure that we review it, right? We catch up again. After implementation, we catch up to go over, okay, we started here, we clarified your goals, then we gave you advice, we implemented that advice. Now let's make sure we're on the same page. And then within a year, we catch up again to make sure that we are on track. And if there's any changes we need to make, we make. And if there's any new opportunity to give you more advice, we do that. So that is how this will work. Hope that made sense. I want to also talk you through about the benefits. Like, what will this actually do to your life, right? So financial planning, if you have proper financial planning in place, essentially this should do this for you. You should never run out of money. You should always have money in emergency money. You should always have a plan for offset account. You should have separate bank accounts. All that is part of, because when you separate your expenses and income, you have more clarity and control over your money. So you should never run out of money. You should be able to automate your savings and investing, whether that's property, shares, managed funds, gold, whatever your interest, it can be automated. And that's how, that's a benefit you'll have. Obviously, you're going to build wealth and grow wealth and make use of compounding. You would only invest in quality assets. You will not risk in investing in something that you don't know and it's not quality, because as a professional advisor, we have to do our due diligence. You have to research before I give you a recommendation on any investments. You save on fees and time. Tax is big again as part of your financial plan. The benefit to you is that you're going to be smart with your tax. You will save tax where possible. You'll do tax deduction where possible. Debt recycling. All that is part of being smart with tax. And of course, all of this, you're going to make sure that your asset and wealth is protected, because the last thing you want to do is you are building wealth, you have a lot of money, you have a lot of wealth, but then it's exposed. Part of financial plan, asset protection is super important. And then you want to make sure that it's also passed on to the next generation, and you have plans in place for it now, today. And that's what financial planning does. It allows you to, benefit from all these things. Okay, I want to now talk to you about what you're going to get as a bonus as part of being here, and that does not cost you anything. So I want to really offer because financial awareness is very important, and I want to do as much as I can from my end. So just because you attended, I'm going to give away some freebies and bonuses, and let me just take you through those things. So you are able to do an engagement and a strategy meeting with me without any cost. So usually after an engagement meeting, if clients are proceeding, we will, make sure that they pay the fees. But here in the webinar, if we take action, there's free engagement meeting, there's free strategy meeting. Basically, you get two meetings where first meeting is all about understanding your needs. A second meeting is all about what can we do, and we can talk about the strategies that we can implement. So you can take a lot of value from these two meetings. I'm going to give away a budget planner, which I really use with all my clients so that you understand your income and expenses and you see where there's a gap and what is your savings capacity. You'll get that. I'm also going to offer you a free wealth builder app. So this is an free app for you, where you can actually bring together your budget, you can connect your superannuation investment. You can see all your financial. You can get live data feed for your property values, all that, your car values, all that for free. You can see it in one place. It's very handy and it gives you an overview of your financial life. I'm going to also give you my cash flow management structure that I provide to my client for free, where you can understand how to structure different bank accounts for different purposes and how you automate that. And then I have a free ebook, which is about financial freedom. It goes in details about things that I talked today, but it also goes a bit more detail. It's in writing, and I'm going to give that to you as well, part of this bonus. So all of that for free. So yeah, hope that you'll enjoy this. And ideally, I obviously love for you to come across and have a meeting with me, and then we can help you in your wealth building journey. But essentially, you're still going to get a lot of value by getting all these freebies. So the offer, though, I have to make sure that there is a timeline. So Monday, which is coming Monday, 14th of the 10th, 24, is the time for you to enroll. So we will send you an email. So I'll send you an email with a link to book in a meeting with me. So you will have an opportunity and with all the links and all the freebies, the bonus that I discussed today. So you don't worry about it. So you'll get that. But please enroll by Monday to make sure that you take this opportunity. Now, I want to talk you through about some of the things that you might have in your mind, right? So the fees in super. One of the common things people don't know is that financial advice, the fees can be paid through your super money. It does not have to come from your own bank account. In fact, the reason for this, the government really want people to get financial advice because they don't want people to go down the Centrelink and knock Centrelink's door, right? So they really want people to take control of your finance. So they have an incentive for people to use the super. You can't touch your super for anything, but to pay for financial advice. And if you want insurances paid, you can have your super pay for insurances premium. These are two common things that you can use your super. Otherwise, you can't touch it until you're age 60, until you retire. So most of the fees that we discussed today can be paid through super. And fees that you pay from your own bank account if you want to is also can be tax deductible. So essentially if it's a 1900 fee, you may just pay like 1300 in total because that's all tax deduction available to you. And if you're just paying from your own pocket, it could be just a few $100s because of tax deduction. And again, there is no upfront fee. So I'm not going to charge you any upfront fee because I know what we do. We will only ask you to pay the fee after we've given you the advice, after you've implemented the advice. So the fees come at the last, not at the front, because we are confident the value that I'm going to add and you'll be, and it's a long term, it's not a transaction. I think this as a journey and take you through this journey and help you build wealth in a smart way, right? So there's no upfront fees at all. So you only pay at the very end. And then the fees can be paid in installments too. So it does not have to be in one lump sum. So all that is available, but you have to take action by Monday. So I'll send you an email and I'll leave it with you and take action. And I would love to see you there. One final thing, everything that's today I discussed is general advice because I don't know your personal circumstances. Please don't take this as personal advice and go take action. I would love for you to sit with me and let me give you the guidance and take it through because you get 2 sessions with me where I will give you a lot of value, personal advice, which is basically suited to your personal circumstance. But don't take action based on what we discussed today because there could be a lot of things which you will easily miss because it's not as simple as what I've told you. There are a lot of implementation and complexity which comes along with it. So I hope that you will not make that mistake. Now, how are we doing with time? Fantastic. Right on time, looks like. So I would now love for people to ask me any questions. I'm happy to answer them. And we'll do this and we'll take it from there. Okay, let's have a look at the questions. Do I have any questions? Thank you, Tejinder. Thanks for the clap. Makes me happy. Thank you so much. Okay, let's take some questions. Let me go through some questions, and please feel free to ask me more questions, guys, and I would really love to answer them. Okay, so I've already answered for Rajesh's question, first question. Then, Fran, you asked me a question. Let's see what it is. Investment bonds do pay corporate tax of 30% every year for earnings. So when we say no capital gains tax when it's sold after 10 years, is it applicable for all investment bonds or are there specific ones that have this exemption? Okay, great question, Pram. All right, good. I love this. No, investment bond, we got to understand this is an investment bond is a tax structure. It's not product specific. It's a tax structure. Just like superannuation is a tax structure, investment bond is tax structure. So the rules are rules. It applies to anyone who holds investment bond. Simple. So the corporate tax rate of 30% is the maximum tax rate. However, in Australia, there are providers who use the franking credit that is available in Australian companies. Now, I'm not going to go into franking credits and explain all that because it's a whole other topic. But let me just give you a context that Australian companies, mainly the banks and the mining big companies, they do something called franking credit, which means they pay tax before they pay you dividends, right? So if you hold a NAB share, NAB might pay you 4% dividends. But before paying the dividends, they've already paid tax on it. So what they do is they give you a refund, which is franking credit, which actually makes your returns go higher. So that's basically what it is. So if it's 4%, your return could be 6% because of the refund. Now, investment bond providers, what they do is because there's a franking credit benefit, effectively they can pass it on to the members. So the tax rate could be much less than 30% corporate tax rate. It could be between 25 and 30%, anywhere between that. So that's why it's quite beneficial for people to hold investment bond because the income tax is quite low. Now, after 10 years of holding that investment bond, we talked about the income. But capital gains, so let's say we start building investment bond and now it's become a few $100,000 or even $1 million. There's no limit to how big the investment bond can be. Unlike superannuation, superannuation has a limit of 1.9 million tax-free in retirement, but investment bond does not. And that's what I do with people where if they've maxed out on super, we then start setting up investment bond, really pumping it up. So to answer your question, there's no capital gains tax at all after 10 years. And that's because investment bond is a tax structure and that is common. It is not subject to the providers or an investment that we choose. Hope that answers your question, Fran. Thank you. All right, let me see what else can I say. Let me know, guys. More questions, the merrier. Happy to answer. Tejinder, what is your question? Do we have to have a minimum income to use financial advice? I'm also FA means financial advice. I'm hoping that's what he's saying. No, not really. It's not the income, Tejinder. What really matters is, do you have a capacity to save? Are you spending less than you're earning? That is the fundamental thing. Now, if you are not doing that, I can still help you to manage your budget to make sure you start doing that. So it's got nothing to do with your income at all. As you know, it's more to do with what you do with your income. This is another misconception. People think financial advice is only for rich people. It's nothing to do with rich or average. It's more to do with how willing are you to take control of your financial life and how committed are you. That's the first thing. Commitment is what comes first. Having an ambition to do well. And then you start thinking about the nitty gritty. You start thinking about how to, save money, how to invest, all those things. So no, there's no minimum, Tejinder. So don't worry about that. There's no minimum. Most people should be able to get financial advice. Okay, what's the next question? Will the fees go below if someone already have an SMSF set up? Uh, Depends. Obviously, there is a minimum fee which we discussed, but yeah, I'm happy to take it with you to Ginger. If we catch up, I'll have to have a look at the situation, see what fees before I can comment on that. But yes, thank you for that question. What is another question? I'm a 60-year-old and I'm interested in retirement planning. Can you help with this? It seems most of your advice is for younger people. I'm sorry, I didn't mean to exclude anybody who is 60 or close to that. No, actually, in fact, Aziz, this topic was such that I had to cover most of that topics. But I love my clients. They are 60-year-old, 67, 60. I remember one of the client story I discussed. This guy is 67 and he's got property portfolio. So I have clients who are up until they're 80. So really, retirement planning is something I'm passionate about too as well. Because think about retirement, people are living up to 90 and 100, and with medical advancement we are going to live longer, right? And I wish good health and good life for all of you. So retirement is just the beginning of another phase in your life, and people are invested for 20, 30, 40 years in retirement. So you need money and planning to make sure you never run out of money in retirement, because the last thing you want is run out of money and go knock gentling. It's not fun. So if you're 60-year-old, I would love to help you and talk about what your current situation is, and how do you want to retire? What sort of income do you want to retire so that you can maintain and keep up the lifestyle that you desire and have a plan in place? And at 60, as I said, it's a great time. There are so many useful uh, tax strategies that we can apply, which basically means that you pay next to no tax, and also get all the benefits. And sometimes age pension is available to people who fall in that bracket. So I would love to help you on that. Please reach out. I'll send you an email. Please reach out and we can talk. Um, yeah, and Pradesh, thank you so much for saying thank you. It's always nice to hear kind words. And I will certainly send an email and love to talk to you guys, just and see what I can do. But I really hope that this was useful. I try to do my best. If there's anything that you want to ask me, feel free to reach out again. You can email, and I will be sending an email, so you can definitely come back as well. Is there any question that you want to ask me, guys? Anything else? Jinder, thank you. It's a great informative session. We'll wait for your email. Have a great day. Thank you. And thank you, I as well. I see only I for retirement planning. Thank you again. Thank you, guys. Loved being here. I'm so glad that you made the effort to come here, and it's been useful. I hope so. And I'd love to see you all. Thank you so much. Take care. Be safe. Bye bye.